Hey, I'm Ben from Modern and today I'm going to talk to you about LGI Homes Inc. and do a Modern valuation. So stick around to hear what I think about this company. So we have LGI Homes Inc. Ticker is LGIH. The current price is $93.32. This sector is consumer cyclical, but the industry is home building. So this is a home builder which traditionally they have done pretty well in the Modern formula. So let's take a look here. Balance sheet. These are the items that I view as most important on the balance sheet, and they will all come into play in this valuation. We have total current assets and total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. Over here we have our earnings graph. You can see about 10 years of earnings. We've gone up and up and up and come back down a little bit. But generally, we're on an upward trend, and that is good to see. Here you can see the data, and you can see the raw earnings have definitely gone up there. Here we have the weighted earnings per share. So I take a 5-year average. Looking at those 5 years, you get the weighted earnings at 12.12, and that smooths out the business cycle. So you can see in 21, there was a big bump on this one's earnings, but it did not get reflected as big of a bump on the weighted. So it helps you get a better idea of the trend in the earnings, and that's what we use for valuating the company. Over here, we have the dividend data. So this company does not pay a dividend, so we don't have much data to work with, obviously. And there isn't much to say about that. No dividend is not a thing that we like to see with Modern stuff, but let's take a look and see how the company fares in the valuation. So stage 1 is to determine if the company is suitable for the defensive or the enterprising investor. These are the two investor types that Benjamin Graham taught about in his book, The Intelligent Investor. The defensive investor is one who's not willing to take a lot of further steps to research a company. So they have stringent requirements on what they might be willing to invest in. Market cap has to be over $2 billion. It passes that barely. It's at 2.1, almost 2.2 billion. The current ratio has to be over 2. This one, it is 14.63. It has a great current ratio. That's good to see. Positive earnings per share for 10 straight years. It does pass that. Dividend payments for 10 years. It does not pay a dividend, so it can't pass that one. Increase of 33% in earnings per share. It has definitely passed that with a whopping 11,000% earnings growth in that time period. PEMG under 20. That is the price over the earnings per share, the weighted figure, and that comes to 7.7. That is below the 20 threshold or requirement. Price to book ratio of 2.5. We're at 1.35 for this one, so we passed there. So it is suitable for the defensive investor. The enterprising investor, it's suitable for as well for two reasons. One, because by default, it is suitable for the defensive investor. And two, because it passes 4 out of the 5 tests. It passes every enterprising investor test except for paying a dividend. And if it just paid even just a penny of dividend, it would pass that test as well and be even better for the enterprising investor. But anyway, if you've liked this so far, be sure to hit that like button and subscribe to my channel, and then download the free valuation calculator found in the description and a pinned comment below. Stage 2 is a determination of the intrinsic value, and remember that the intrinsic value of a company is independent of its price. The value is what the company's worth. The price is what the market is willing to pay. In this situation, we want to calculate the intrinsic value, and we use Benjamin Graham's formula from, again, The Intelligent Investor, and we get value equals earnings times 8.5 plus 2 times the growth rate. I use my weighted average of earnings to make it the Modern Graham value formula, and so we have two variables to figure out. We have earnings and growth. Earnings, again, we take a 5-year weighted average of the earnings, and we get 12.12 for that earnings per share Modern Graham. Growth, we take that 12.12 and we look at the figure from 5 years ago, which was 444, and we calculate the total growth between those two is 173% growth. Divided by 5, we get an average growth of 34% per year. Now, we have two caps here. One is a safety margin of 0.75. So we multiply 34 times 0.75 and we get to 25.96% for the growth. But that is just one cap. The second cap is 15%. That's the maximum growth that I'm willing to have the value formula use, because this is a growth rate in perpetuity. And while a lot of companies grow at very, very high rates for a very long time, it is not sustainable to have a super high growth rate in perpetuity. And that's what this formula is looking at, is a value of growth of earnings in perpetuity. So we cap it at 15%. So if we put the earnings per share of $12.12 and the growth estimate of 15% in, we get a value of $466, which is significantly higher than the price. And in fact, the price is only 20% of the intrinsic value, so it is significantly undervalued. And you can see, looking at the graph here, how different they are. The price is way down here, and the value is way up there. A couple other figures to look at. One, we have the value based on 3% growth. So if we assume the company will grow by just 3% in perpetuity, we get a value of $175. If we assume that it will not grow at all, the value based on 0% growth is $103. So we get a company that, if it stays stagnant, will be worth more than the current price. That is very interesting. The market implied growth rate is if you put price in for value here and then you solve for growth, you get a market implied growth rate of negative 0.4%. So the market is saying that the company is going to shrink by 0.4% every year in perpetuity. If you think that is inaccurate and you think the company will grow, then that might be a signal that it is undervalued. Now, coming down here to the grade, we have a couple of issues, but we can work around it. The spreadsheet doesn't like it when there is no dividend at all. And in fact, this is trying to pull from some data that I use, and because there's no dividend, there's no data being pulled. And so we get an error in the formula there. But looking at this, investor suitability, it is suitable for the defensive investor, so it gets 2 points. A good price to value, it gets 1 point. It's because it's undervalued. It's trading below its gram number, which we'll talk about more in a minute, so it gets another point there. It doesn't get a point for value for dividend growth. It does not get a point for having dividend yield above 2%. And it is trading below its industry average, so it gets a half a point there. And this one is trading below its net current asset value, which is very, no, it isn't. No, it isn't, because net current asset value comes to 62, but the price is 93. I'm not sure why it is showing that. I'll have to check on that, but let's not count that. So we get 2, 3, 4.5 points on the chart. That would give us an A minus. Stage 3. So we have further research. If you've determined that this company is undervalued, which, as we've talked about, it is, and you've determined that it's suitable for your investor type, then you might want to do further research to determine if it would be a good fit for your individual portfolio, taking into mind your own investing goals and your diversification and stuff like that. These are some things that might be useful to you. One, the net current asset formula. So what we do here is this is trying to give you a floor for the price. So it's a floor because if the company were to take all of its cash, its current assets, and to pay off every single one of its liabilities, and then distribute the cash to what the shareholder, or like all of the shareholders, then you'd have about $62 per share. So that is what the minimum price should be, because the company could be completely liquidated and still give the shareholders $62 per share. That is very significant. The gram number formula is something that is derived from Benjamin Graham's defensive investor requirements. And in this case, we get a gram number of 129.73, which is higher than the price. that is also an indication that it might be undervalued. The PEMG, the price to earnings, is 7.7. The current ratio is 14.63. The price to book is 1.35. And again, the dividend yield is 0, and it has not had any dividend growth because it doesn't pay a dividend. Looking at the chart, stage 4 of the analysis is to determine whether or not it's a good time to buy. We want to try to price it right, because if we've gotten this far and we've determined that it's a good fit for a portfolio and a good value and is suitable for your investor type, then it's time to start figuring out when is a good entry point, because you want to maximize your profits. This company has been on a downward, or was on a downward trend beginning in May of 21, and you can see this was kind of the upward bound. It did break above that for a little bit in December of 21, but then it came back down and tried to stay above it, but failed. So it came back down all the way down to the lower end of this trend line, and then it stayed in there. And again, it broke below that time, and then it came back up and it tried to bounce back into there, and it had some trouble. And it fell because it wasn't able to break through, and then it bounced back up and came through here, and then it hit that upper bound again, and it has continued to stay in there, and it seems that right now it is struggling at that point again. These red horizontal lines are support and resistance levels. You can see, let's zoom in now a bit here. We've had a bit of bouncing around with these levels, and we came down here, which then became another support level for there. So now the company's trying to stay above this downward trend line. The other thing that's interesting about this one is the RSI, which is the Relative Strength Index. And you can see that it has alternated between a bull pattern and a bear pattern. So a bull pattern would be shown by it staying, or like having times above 70 RSI. And when it's in a bull pattern, it will come down and it won't fall below 30 RSI. It might come down and it will come back up. RSI, by the way, is an indicator of whether a company is oversold or underbought. And here it came back up, but then it came back down. It failed to get back above 70 that time. And then it fell back and maybe entered a bear pattern in January of 22, which is indicative of this downward trend. But in August of 22, it broke above 70, which might have signaled that it was entering a bullish pattern again. And that's when it tried to break above that trend, but it failed. And so it came back down. And what's interesting to me is that it bounced from a below 30 to above 70, and then back to below 30, which might indicate that it's starting to be in a little window pattern, or an up and down pattern here. And so it would be very interesting, one, to see what it does here with this trend. If it comes back down and it fails to cross that, then I'd be watching this support level here. And if it fails that, it will definitely have a lot of momentum to come back down here. But if it does break above this and stay above, I'd be watching this resistance level. And if it can break above that too, I'd start to feel a little bit more confident that it might be entering a bullish pattern, and it would be definitely one to watch. And of course, keep in mind that net current asset value, which is right around here. So if it does continue to fall, that would be the next major thing to keep an eye on. But that is it from me today. Be sure to click on what is on the screen now, and I will catch you next time. Take care.